In today's video, we're going to be looking into what DeFi means and how it works somewhat. We're going to try to simplify DeFi and help you to understand how it connects to the financial system that we have today. Welcome to Silver Altcoin, where we bring you quick facts, information, economic benefits, and trending news on the various altcoins in the cryptocurrency and DeFi space. This is no financial advice. Crypto is highly speculative and investing in it is risky. This is purely for informational and educational purposes, and you need to do your own research. So, what is DeFi? DeFi simply means decentralized finance. Now, decentralized finance or DeFi is financial services built on distributed networks with no central intermediaries. So it simply means DeFi is a variety of decentralized financial services that aim to replace our current centralized financial system, like our banks. The system removes controls that the banks and other financial institutions, as we know it today, have on money, the control they have on financial products, and the control they have on financial services. Financial services may include money transfer from one person to another, from one person's account to another's account. Financial services may include loans, mortgages, insurance, any kind of, borrowing that we know of, car loans and all that. Financial systems, like we know today, are centralized. Our banks, our insurance companies, our stock markets, our mortgage institutions, and so on, where people are in control of these services. This centralized financial system is known as CeFi or centralized finance, and it's got its pros and cons. It's got the good side and the bad side, just like every other thing. But what are some of the disadvantages of the CeFi, the centralized finance that we have today? Some of the disadvantages include mismanagement of funds, fraud. I mean, we hear of fraud all the time. And another disadvantage is very minimal return on investment. We hear of our banks giving us 0.05% annually on our savings and our investments. And as you know, most of the profits that are made using our savings and investments are used to pay for overhead expenses. So that's why we get so little sometimes. And we hear of high interest rates on loans and credit cards. So these are some of the disadvantages of the centralized finance system that we have in place now. But what if there is a way to decentralize the financial system as a whole? What if there is a way to cut out these overhead expenses that are being paid, in the centralized financial system? What if there is a way to avoid the looting and the fraud that sometimes happen in the CeFi space? This is what DeFi is trying to achieve. This is what DeFi is all about. So DeFi refers to financial services and systems that have no central authority nor someone in charge overseeing things. So the DeFi cryptocurrencies and ecosystem are coded and programmed to build exchanges, lending services, insurance companies, and all the financial products and services that do not have an owner in order to replace the services offered by CeFi or in CeFi. Now, in order to create a decentralized financial system, there would need to be three things: cryptography, that is secure information and communication techniques that are derived from mathematical concepts and a set of rule-based calculations. And there will need to be blockchain technology, and there will need to be smart contracts. So this is one of the great things about Ethereum, Ethereum has got all these necessary technologies to support DeFi already in place. And that is why the Ethereum ecosystem is big and is used in DeFi. So through the use of smart contracts that are automated codes that manage financial services in a decentralized manner can be written. And once these codes are written, the rules are written into these codes and deployed, and they become immutable. They cannot be changed, and no single person or government has authority over them. Now, in order to have a financial services system, there are some things that need to be in place. There are some building blocks that make up a financial system. There would need to be money, there will need to be an exchange, need to be money markets, and there will need to be insurance, and perhaps some other things. Now, let's talk about the first thing that needs to be in place for a financial services system to be built. There needs to be money. But in this case, we need a stable currency, one that is not so volatile like the Bitcoin or Ether. So one that will be stable enough to allow people understand how their money is working for them and to have a reliable way to buy and sell crypto coins. So this is where stable coins come in. So in the DeFi system, we need stable coins, or in the cryptocurrency system, we need stable coins. But in the DeFi system, we need stable coins as well. And these stable coins are pegged to the value of a real world traditional asset like the US dollar. So some stable coins you may know of are USDT, USDC. We find this commonly in the centralized cryptocurrency world. But for the DeFi space, we also have the DAI, the DAI. It spells DAI, DAI. So DAI is a decentralized cryptocurrency that is pegged against the value of the US dollar, meaning that one DAI equals one US dollar. So unlike other popular stablecoins whose value is backed directly by US dollar reserves, DAI is backed by crypto collaterals that can be viewed publicly on the Ethereum blockchain. So it's slightly different because it's on the DeFi space and everything has been coded into the smart contract. So the DAI stablecoin is also a smart contract that is on the Ethereum platform, making DAI a truly decentralized stablecoin, which cannot be shut down nor censored. So it's the perfect form of money for the decentralized services. Now that our decentralized financial system has stable, reliable, decentralized money, we can go ahead to add other necessary and important services like a decentralized exchange DEX. So after we've got our money, now we need an exchange to swap these currencies, or in this case, cryptocurrencies, right? So much like the traditional exchanges, decentralized exchanges operate according to a set of rules through smart contracts that allow users to buy, sell, or trade cryptocurrencies. Just like DAI, they also reside on the Ethereum platform, which means they operate without a central authority. So when you trade on a decentralized exchange, DEX for short, DEX, there is no exchange operator. There are no signups, no KYC, identification verification, and you pay very little fees, unlike in traditional exchanges where you could be charged fees as high as 15%, 20%, or more. So instead, the smart contracts are there to implement the rules. It's been coded in the smart contracts. So they are there to implement the rules. The smart contracts will execute trades and securely handle funds when needed. In the decentralized exchanges, they work in a manner where investors pool their money together and then traders can trade that money, where the fees of every trade goes back to these investors. So in the decentralized exchanges, a government can't step in to make demands, and they can't step in to change up things. Things have already been coded. It cannot be changed just like that. So the fees and the percentages are locked as they are written in codes. So they don't change, and they can be raised to crazy prices. So decentralized exchanges like Uniswap, PancakeSwap, those are the two common ones, but there are so many others. These exchanges have opened up the world to a whole new variety of tokens and coins that you probably haven't even heard about. So another thing that is needed is the money markets. So now we've got our money, our stable coin, and we've got an exchange, a decentralized exchange. The next thing would be the money markets, a market that now connects the lenders and the borrowers. So another huge and necessary part of our current traditional financial system is based on lending and borrowing of money. So it would make sense that the blockchain decentralized finance should have this and possibly do it better. In the traditional centralized financial system, one of the reasons individuals can reliably lend and borrow with banks is because they usually have to put down something, say a 20% down payment, like when you're borrowing for your house mortgage. So we put down a 20% collateral so that if they never pay back the full loan, if someone is not able to pay back the full loan, our government can go after them and throw them in jail, or they can, have a way to make them pay this money, even if it means, garnishing their wages and all that. So simply put, there are legal consequences when you don't pay back a loan. We know that it ruins your credit and all that. But with crypto DeFi, things work a little bit different, because one of the pros of the decentralized finance or the decentralized system is anonymity. And given the same scenario above, you could put down 20% and then run away with the rest of the loan, never to be seen again, right? If you're giving a loan and you're asked to put down 20% and nobody knows who you are, because that's what happens in the DeFi space, no one knows you, you don't do a KYC, you could run away with the money. So how do we solve this in the decentralized space? Well, in order to avoid this anonymity disappearance with loans, there had to be something coded into the smart contract to allow for lending and borrowing funds the right way. And for a person to get a loan, they must be able to over collateralize that loan. So what that means is that they will not put down the 20% collateral. No, that's not how it works. In the traditional sense, that's how it works, but in the DeFi, it doesn't work that way. So you will need to put down more than you are borrowing. What? Wait a minute. What do you mean I need to put down more than I'm borrowing? It doesn't make sense. Now, why am I borrowing in the first place if I already have the money? So let me try to break it down and explain it a little bit. In decentralized, it is peer-to-peer, trading transactions going on. So for an individual to be able to borrow some money on crypto tokens, there must be another individual that is willing to lend that money or tokens. So let's say if a man wants to borrow $100, he must put up 120 or $150 worth of assets. So that way, if he runs away and never pays back his loan, the smart contract, which has been written in a way to protect the lender, will be implemented so that it can pay back the lender their money, their tokens, plus the interest that have been accrued. So the lender puts that money, he agrees to lend to other people in the hopes that he will get an interest over time. So you might be wondering, what's the point of taking this loan if I already have the money? Well, as an example, if you have 10 Ethereum tokens that are worth $5,000, because each of the token is $500. You don't want to sell them because you believe so much in the Ethereum project, the ecosystem, and you know that it's going places. You know that it is going to explode, or at least it's going to gradually increase. So what you do is you need money, so you can borrow. You can use your 10 Ethereum tokens to borrow, maybe say $2,000 worth of USDT. Now you have 10 Ethereum tokens worth 5,000, but you want to borrow $2,000 worth of USDT. Remember, USDT or DAI is a stable coin. So you want to borrow a stable coin that is equivalent to the US dollar, $2,000. So what you do is this $2,000 is now yours. It will be given to you as long as you have more than $2,000 in tokens that are in your wallet. So they will be given to you. The $2,000 will be given to you. You can use it for any emergency. You can use it for whatever you like. But let's say you trade that $2,000 and you make some money. You trade it, you use it over time, and you make some money. Say you have, $2,000 and you make, $1,000 extra. Now you have $3,000. So you pay back your $2,000. Now you have an extra $1,000 that you made while trading the $2,000. So you pay back your $2,000, you have your extra $1,000, and you still have your 10 Ethereum tokens. See how that works? Now, in this example, you made $1,000 in profit. So while you trade, but that doesn't always happen because you could potentially lose all your money. You could potentially lose all the $2,000 that you borrowed and you decided to use for trading. In that scenario, if you lose all of it, no worries. They've got your $5,000 worth of Ethereum tokens. It's possible that these Ethereum tokens have even gone up. It's possible they've gone down in value. Whatever it is, they will still be able to recover their $2,000 loan that was given to you, and whatever is left will be yours. However, if you made money in this example that I gave, you still have your Ethereum tokens, which has possibly gone up in value, and you would have made $1,000 from the $2,000 that you borrowed. So this is how DeFi works, and this is the power of DeFi lending and borrowing. The other thing that is needed for a decentralized finance system is insurance, decentralized insurance. Just like the traditional banks, just like decentralized finance, have insurance to insure investors and give their customers peace of mind. DeFi has to have insurance in place to insure investors' funds and gives the much needed peace of mind, especially because it is very new, and with all the new products and with the anonymity and all, it can really go wrong. So insurance is highly needed to have a DeFi system, and that is also obtainable in the DeFi system right now. As we can see, DeFi, decentralized finance, offers several advantages like decentralization, transparency, synergy, flexibility, higher return on investment, and better user experience, to just name a few. However, with advantages comes disadvantages. So we've got disadvantages that you should be aware of. The decentralized finance is so new that it hasn't been fully tried and tested, and things can go completely wrong. We know of smart contracts that have been, hacked in the past. They've had issues just because the rules were not clearly stated and they were not properly defined. And hackers, they just found a way, to exploit the loopholes. So hackers are continually looking for these loopholes. So you yourself have to read the contracts and make sure that whatever project you're trying to invest in is clearly secured, and your money is protected, because you could lose all your money if you don't know what you're doing. And if you lose your DeFi wallet password, you could lose all your money. So these are the advantages and disadvantages of the decentralized finance. So now that we've tried to cover what DeFi means and how it works, hopefully, please remember crypto investing is highly risky. Now, if you've learned anything in this video, do hit that like button and consider subscribing, and turn on notifications for more quick facts, information, and trending news on crypto and DeFi. Thank you so much for watching, and we hope to see you in the next one. But till then, keep learning. Bye. Take care.